The stock market just posted a massive, 24% gain over the last year.
Yeah, it's been an incredible run.
Right. So if you look at the headlines, everything seems just fantastic. But if you look at a highly sensitive 4-hour chart from August 7th, 2026, the market is quietly screaming that it's entirely out of breath.
Completely exhausted.
And today, we're going to show you how to actually hear that warning.
Because it's really all about looking under the hood. Headlines tell you where the market has been, but technical indicators, especially on a granular time frame, they tell you where it's about to stumble.
Exactly.
We are looking at this highly technical stack of charts and sector analyses for the KSE-100 index, captured right at that critical August 7th juncture.
And our mission for this deep dive is to basically act as your translators, because we have this absolute mountain of data here.
Oh yeah, it's a lot.
We've got stochastic RSIs, support and resistance channels, volume bars. To a lot of people navigating the market right now, that just looks like, well, an uncracked ancient treasure map covered in jagged lines.
Right, just noise.
But we're going to decode this map. By the end of our conversation, you're going to understand exactly where this market is running dangerously hot and where it's, taking a strategic nap and where the hidden bullish opportunities are actually buried.
And the key to this entire map is the time frame we're using. We are relying heavily on the 4-hour charts.
Which is a very specific choice.
It is. And it's a crucial detail for you to keep in mind.
Yeah.
Because if you look at a daily chart, it's just too slow.
Right.
Right? It smooths over all the immediate warning signs.
Yeah, you miss the nuances.
Exactly. But if you look at a 15-minute chart, it's just frantic intraday noise. So the 4-hour chart really hits that sweet spot. It reveals institutional moves and near-term momentum way before they become obvious to everyone else.
So before we can start picking out individual ships, I feel like we have to understand the ocean they are sailing on, right? We have to start with the broader market.
The KSE-100 index itself.
Let's set the scene based on the data. The market closed on August 7th, right around 181,430.02. Now, it saw a very slight daily dip. It was down about 346.57 points, which is
practically nothing.
Yeah, it's down 0.19%. Intraday, it bounced around a bit. High of around 181,647, low of roughly 180,620.
But the volume was undeniably strong.
Oh, massive. Over 376 million.
Which tells us there is still immense participation in this market. People aren't just, sitting on the sidelines. There is active, aggressive exchanging of hands happening.
Right. But here's the context that really matters. Despite that tiny, almost negligible daily drop, the one-year change for the KSE-100 is that massive 24.57% gain we mentioned.
Yeah, a huge run-up.
Even the year-to-date gain is sitting comfortably at 4.24%. So, okay, let's unpack this for a second.
Sure.
If the broader market is up nearly 25% over the last year, why should you or anyone else trying to navigate a portfolio care about a microscopic 0-point-something% dip on a random day in August?
Well, if we connect this to the bigger picture, that tiny dip is actually a symptom of a much larger underlying condition.
Like what?
It's like a microtremor before a fault line shifts. And to really see that condition, we have to look at the stochastic RSI on that 4-hour chart. The index's stochastic RSI was sitting at values of 91.6 and 95.5.
Hold on, I want to pause you there because I know what a standard RSI is, right? The relative strength index.
Right, the classic one.
It measures how fast prices are moving to see if a stock is overbought or oversold. But you're specifically looking at a stochastic RSI. What does that extra word actually change about the math we're looking at?
It's a really great distinction to make. A standard RSI tracks the speed of price. But the stochastic RSI applies the stochastic formula to the RSI itself.
Okay, so it's a derivative of it.
Exactly. It measures the momentum of the momentum. It tells us where the current RSI is relative to its own high-low range over a set period. It is incredibly sensitive.
So it's essentially the RSI on a heavy dose of espresso.
That's a great way to put it, yeah. It reacts much faster to shifts in momentum. And in the world of stochastic RSI, any reading over 80 is universally considered overbought.
Mathematically speaking, anyway.
Right. Mathematically, it means the buying pressure has pushed the price up too far, too fast, and a correction, or at least a pause, is highly probable.
Got it.
So when you see the broader KSE-100 index sitting between 91.6 and 95.5, well above that 80 threshold, It strongly suggests the market is deeply exhausted. The buying power is mathematically just tapped out.
I like to think of the KSE-100 right now as like a marathon runner.
Okay, I like that.
This runner has just sprinted an absolutely phenomenal race over the last year. That's your 24% gain. They crossed the finish line. The crowd is going wild.
Cheering them on.
Right. But right now, they are leaning heavily against a tree, just gasping for breath. That gasp for breath is what analysts call a consolidation phase.
Mm-hmm.
They aren't turning around and running backward. That would be a full bear market. But they simply cannot sprint another mile right this second.
That's a perfect visual for market consolidation, honestly. The momentum is temporarily peaked. But, an index is just a mathematical average of many different companies.
Right, it's just a basket.
So what's really revealing is when you look under the hood of the index to see the specific mechanics, which sectors are actually causing that exhaustion?
Well, let's do exactly that. Let's move from the overarching market to our specific sector heat map. Because if the KSE-100 is leaning against a tree, there are specific heavyweights that dragged it there.
Exactly.
Looking at the data, the cement sector is practically glowing red. I mean, I'm looking at Lucky Cement ticker LUCK.
Yeah. Lucky Cement is the most extreme example in our data stack today. On August 7th, it was trading around 459.
Okay.
But its 4-hour stochastic RSI was what technical analysts call deeply overbought. It was sitting at 97.19 and 96.99.
I mean, 100 is the absolute mathematical ceiling, right?
Oh, yeah.
Physically cannot get much closer to maxed out than 97.
You really can't. And when a stock is stretched that far, you have to stop looking at how high it can go and immediately look down at where the safety nets are.
The support levels.
Yes, the support levels. Because gravity is about to kick in. Lucky Cement has immediate resistance. That ceiling, it's struggling to break around 464.80.
Okay.
But if that overbought pressure finally breaks and the sellers take control, its first line of support is at 456.94.
And looking at the chart, if that 456 level fails, there's this massive gap. The next structural support levels don't show up until 438, and then way down at 422.28.
Yeah, it's steep.
That is a massive air pocket for a stock to fall through.
And we really need to explain why air pockets like that form for you. When a stock goes up on pure, unadulterated momentum, just frantic buying, it skips over the process of building structural support.
Right, because people aren't leaving limit orders at various price points on the way up.
Exactly. They are just hitting buy at market price. They just want in. So when the tide turns and people want to sell, there are no structural buyers waiting below to catch the falling knife.
Wow.
The price just free falls until it hits a level where buyers finally see value again. For Lucky Cement, that could be a very long drop.
And the terrifying part is that it's not just Lucky Cement acting in isolation. We see DG Cement with a stochastic RSI up in the 84 to 91 range at 218.91. Maple Leaf is flashing an RSI of 85 to 92, trading at 102.20. The entire sector is completely out of breath.
Yeah, it is.
And then you look over at energy and petroleum. Mari Energies is trading highly overbought at 95 to 97, sitting at a price of 681.88.
And PSO is joining them.
Right. Pakistan's state oil is just entering that danger zone, crossing the 76 to 81 threshold at 351.
What's fascinating here is the synchronicity of it all. We are looking at foundational energy, construction materials, and even smaller sectors like automobile and property.
Yeah, Gantara Tire and Rubber is overbought in the mid to high 80s at 35.60. TPL Properties is doing the same thing at 15.04.
Right.
So why does that happen? Why do entirely different industries all run out of breath at the exact same time?
Because of how modern institutional money operates. Institutions rarely buy single stocks anymore. They buy baskets or they use sector-based ETFs and algorithmic trading.
So it's all automated?
Mostly, yeah. If an algorithm detects a macro trend, it buys the whole cement sector at once. It buys the whole energy sector at once.
Oh, I see.
The result is that these stocks move in lockstep. But the downside is systemic risk. When almost every major sector is simultaneously flashing momentum numbers in the 80s and 90s, the risk of a market-wide pullback increases exponentially.
Because everyone is exhausted together.
Exactly. It's not just one stock getting heavy, it's the entire market carrying too much weight at once.
So if you're holding these heavyweights, you are watching those support lines we mentioned like a hawk basically praying they hold.
Yeah, pretty much.
But this creates a very interesting dilemma. If I'm an institutional manager or just a savvy retail investor and everything from cement to energy to real estate is flashing red and screaming overbought, what do I actually do? Do I just sell everything and sit on a pile of cash?
Well, retail investors might go to cash, but institutional managers usually can't.
Why not?
They have mandates. They're paid to be invested in the market. They have to park that capital somewhere.
Which naturally brings us to the sectors that are not overheated. The oases in the desert.
Yes, exactly.
Let's talk about Pakistan Telecommunication Co. Ltd, PTC. It's trading around 72. And unlike everything we just listed, PTC's stochastic RSI is sitting at a very cool, very calm 56.96 to 70.07 range.
That is firmly in neutral to bullish territory. It hasn't triggered that 80 threshold yet. Has plenty of room to breathe.
Here's where it gets really interesting, though. While the rest of the market is totally exhausted and gasping against that tree, telecom looks like it just woke up from a refreshing nap.
It does.
But let me challenge the setup for a second. If the heavyweights, like the cements, the energy start to sell off and drag the broader KSE-100 index down with them, won't gravity just drag PTC down too?
It's a fair question.
I mean, does it really matter that his RSI is neutral if the whole market is tanking?
It's a very valid concern. And yes, in a severe market crash, all correlations go to 1. Everything drops.
Right.
But in a standard consolidation phase, which is what the 4-hour charts are predicting, capital rotation provides a buffer. Smart money looks at Lucky Cement at a stochastic RSI of 97 and sees terrible risk to reward.
Sure.
But they still need market exposure. So they actively sell their cement shares and rotate that money directly into charts that are consolidating healthily, like PTC.
Wait, so you're saying the sell-off in the overheated sectors actually provides the fuel, the capital, to push the neutral sectors up?
Exactly. Spotting these oases is exactly how savvy investors avoid buying at the absolute top of an overheated market. They step out of the traffic jam and onto the open road.
That makes total sense.
And if you look at the mechanics of PTC's chart, it reflects a very defensive posture.
Yeah, let's look at those mechanics. PTC has an immediate resistance ceiling around 75.35 that it needs to break through, but the downside is what really caught my eye.
The support levels.
Right. It has incredibly strong, staggered support levels, forming a very thick safety net, starting at 70.41, then stepping down to 62.80.
That staggered support is crucial. Unlike the massive air pocket we saw in Lucky Cement, PTC has layers of buyers waiting below the current price.
So it's padded.
It's structurally sound. It offers a defensive, fortified position in a market that is otherwise dangerously overextended.
Okay, so we've mapped out the overheated traps. We've found the defensive hiding spot in telecom. But playing defense isn't the only way to make money, obviously.
Definitely not.
We need to look at the active bullish standout in this data stack. We are diving into TPL Corp Ltd, ticker TPL.
This one is fascinating because it is writing a completely different technical narrative from the rest of the index.
TPL is currently trading at 20.70. And when you look at its 4-hour chart, it is trading inside what technical analysts call an ascending parallel channel. For those trying to visualize this, it basically means the stock's price is zigzagging up and down, but both the highs and the lows are consistently getting higher, forming a tilted upward channel.
Right.
Right now, TPL is sitting in the lower to middle portion of that channel, which mathematically means it has plenty of room to run upward before it hits the ceiling.
The channel structure is excellent, but it's actually the momentum indicators acting inside that channel that make this setup so compelling.
Right, because while the broader KSE-100 is suffocating at an RSI of 95, TPL's stochastic RSI is incredibly low. It's sitting at 37.38 and 26.95.
Yeah.
And crucially, it has recently crossed upward from even lower levels.
That upward cross is vital.
Yeah.
In stochastic terms, when the fast-moving line crosses above the slow-moving line from a low baseline, it signals a shift in underlying momentum.
So the vibe is shifting.
The sellers are exhausted and the buyers are stepping back in. It's a spark.
And if you look at the standard 14-period RSI, it's at 62.02. That means it is safely above the neutral 50 line. So the overarching trend is positively bullish, but it is still well below the 70 or 80 overbought threshold.
It's sitting right in the sweet spot.
It really is. But I have to play devil's advocate again here.
Go ahead.
So what does this all mean for the macro view? This raises an important question. How does a single stock maintain an independent upward bullish trajectory when the entire macroeconomic weight of the surrounding index is getting ready to consolidate.
That's a great point.
Isn't buying into a stock like this right now just walking into a trap? What gives TPL the strength to swim against the current?
That is the million-dollar question, and the answer lies entirely at the bottom of the chart. Volume.
Oh, volume.
If you look at the data, TPL experienced a massive, notable increase in trading volume during late July and early August. In technical analysis, we have a saying, price movement without volume is just a rumor.
But price movement with high volume is a verified fact.
Precisely. It's the lie detector of the stock market. You can manipulate the price of a thinly traded stock with a few $1,000s.
Sure.
But when millions of shares are changing hands and driving the price up, that confirms real, deep-pocketed investor interest. That high volume validates the price breakout and acts as an engine.
So it sustains the stock's upward journey within that ascending channel, completely independent of what the broader market is doing.
Exactly.
So what does this all mean? If you are an active investor looking at TPL, what is the actual roadmap going forward?
Well, looking at the chart, the immediate resistance, the next hurdle it has to clear, is sitting at 22.08.
Right.
And if that heavy volume engine can push it through 22.08, the major target on the horizon is 26.61.
And as always, we can't ignore the downside protection.
Never.
Support is immediate at 20.54, with a dense cluster of safety nets just below that at 19.99, 18.94, and 18.24. I want you to visualize TPL's chart for a second. Imagine you're walking up a steadily rising staircase. That's your ascending parallel channel.
Okay.
And as you walk up, you are holding onto a very thick, very solid wooden handrail. That handrail is TPL's long-term, upward-sloping, dynamic blue trendline support, which intersects right near that 18.50 to 19 range. Compared to the frantic, breathless sprinting we saw in the cement and energy sectors, TPL is making a very structured, supported, and confident climb.
It's a great analogy, really, because it highlights the fundamental difference in market mechanics. It's a difference between momentum built on pure late-stage hype versus momentum built on structural market mechanics.
Institutional accumulation, verified volume, all of that.
Exactly.
So let's pull back and look at the entire treasure map we've just decoded today. We started by looking at the broader KSE-100 index. It has had a phenomenal year, up over 24%, making everyone feel incredibly bullish.
On the surface, yes.
But when we drilled down into the 4-hour charts, specifically looking at that highly sensitive stochastic RSI, it revealed a market that is heavily overbought and desperately gasping for breath.
Right.
We saw how algorithmic trading and sector ETFs have caused heavyweights in cement, like Lucky Cement, and energy giants like Mari, to carry massive synchronized momentum risk.
Meaning they are highly likely to need a breather.
Yeah, and could very well test those lower support levels, potentially falling through some scary air pockets.
But the most important takeaway is that a tired index doesn't mean a dead market.
No, not at all.
Capital rotates.
Far from it, because when we let the underlying technicals guide us rather than just the headlines, we found the safe havens.
The oases.
We found the cooling oasis in telecom with PTC offering a structurally sound defensive setup with a thick safety net of limit orders waiting below. And finally, we uncovered the genuinely bullish, high-volume setup in TPL Corp.
Proving that active upward trending opportunities always exist if you know how to read the parallel channels.
And look for volume validation.
Exactly. As we wrap up, I'd actually like to leave you with one final, slightly provocative thought to mull over as you continue to study these charts on your own.
Ooh, all right. Let's hear it.
Today, our entire analysis has relied on technical indicators. Stochastic RSI, volume bars, parallel channels. These are fantastic tools because they tell us about momentum, institutional footprints, and the unyielding laws of financial gravity.
Right.
But what happens to these perfectly drawn, mathematically sound charts when a company suddenly drops incredibly positive fundamental news?
Oh, man. The ultimate debate, fundamentals versus technicals.
Exactly. Think about it. Does a stellar surprise earnings report or the announcement of a massive new government contract temporarily break the laws of technical gravity?
That's a great question.
Could it push a deeply overbought stock like Lucky Cement even higher, ignoring the RSI entirely? Or will the technical charts ultimately always win, eventually pulling the price back down to its mathematical support levels, regardless of how good the news is?
It's the classic tug of war.
Keep your eyes on those resistance lines we discussed today, because observing that battle, The war between underlying fundamentals and overextended technicals is where the real market drama actually happens.
And observing that battle is exactly what makes watching these numbers so endlessly fascinating. The map is never static. It is always updating in real time.
Absolutely.
Well, thank you for joining us on this deep dive to decode the hidden topography of the KSE-100. Keep questioning the data, keep looking for the why behind the numbers on those charts, and we will see you next time.